All right, welcome back. My next guest, he always seems to be on with me every time we've got a real big, important news release right around the corner. This time it's going to be NVIDIA tomorrow afternoon, and we're going to get some more jobs numbers, too, in a few weeks' time. If you rewind the clock about, 3 weeks ago, it was that jobs report and worries about artificial intelligence budgets and also a little bit of the Japanese yen carry trade that helped send us into our latest swoon. But, we recovered, but not a lot has really changed except for the Fed's focus, I think, right? It seems as though they've shifted from inflation to jobs and what the economy is doing. Now, Powell mentioned this as much with his comments from Jackson Hole last week, but inflation is still around, right? It's up 2.9% at the last read, which, by the way, folks, is 2.9% higher than last year's 3.2% reading. So, again, we're still compounding. It's a positive number. Prices are still going up, not down, right? But what if we do get these rapid-fire interest rate cuts they're talking about, maybe 3 by the end of the year? What does that do to a much higher housing component in the CPI? We just talked about what all this money that the government's giving first-time buyers. It just seems to me that for all those investors that wanted rates to get cut, they're going to get their wish, but for all the wrong reasons, right? The cuts are going to come because the economy is weakening, not because we've got inflation under control. My next guest watches these things all day. Please welcome to the show, Craig Bolanos. Craig, we have talked about this on the radio show a lot. And you probably would say, maybe I'll guess, you don't care either way, you'll take the cuts. But it seems as though there has been a subtle shift from inflation under control to, we got a little bit of a problem with the economy, but you better start cutting rates now. How much do you think is still inflation, and how much do you think of it as the economy starting to weaken?
Oh, there's a dual mandate. The Fed is clearly worried about the labor market. I repeat, the Fed is clearly worried about the labor or the jobs market, and that's the reason for the cuts. And I hope they're not that worried. That's why I'm hoping we just get 25 basis points. I don't want a full 50, because if they go a full 50, things are much worse than we anticipate. They're much worse than Wall Street anticipates. There's a little bit too much complacency out there right now, and we're all going to have to fight against that.
Okay, so I'll put it out there. I mean, you're a smart guy. You run a great business. But I think that it's going to be hard for them. And they put themselves in a position where they might cut these rates because of the labor market that you just mentioned, which is all fair and good. That's fine. I get that. But at the same time, I'll give anybody a free round-trip ticket, airfare, and a hotel if they can come on my show and tell me how interest rate cuts help bring inflation down.
I don't have an answer. I can't give you a one-to-one correlation. I'm a student of finance. That's exactly right. Okay. And if you lower interest rates, that is a stimulative effect. That does not help with inflation. But I think the big picture, Scott, is, hey, there's definitely some cracks in the labor market. We better get in front of it before a whole lot of people potentially start to find their job lost, right? We're talking reductions in force, no longer about global outsourcing. But don't worry, tomorrow the world is going to be saved via the face-melting earnings that are NVIDIA. And I have no other way to say it. I mean, what other company has earnings growth of 500% over the last 3 quarters? We'll see what gets printed tomorrow.
Well, and that's why you've got a lot of these markets in purgatory here today, waiting, and it'll probably be that way all day tomorrow. Again, waiting for tomorrow afternoon, 4:10 Eastern, 3:10 Central. But you know what? You're right about this jobs, and that's how the Fed is looking at things. It is about the jobs. But again, if they cut rates too quickly, too deeply, like you've been mentioning, they do run the risk of inflation heating up. And here's my problem. I mean, 2.9%, yeah, it's got a 2 in front of it. There have been some guys we've had on the show that take all the other inflation reads and average them together, and it comes out to around 2.5%, 2.6%. It's not quite the 2% that the Fed wants, but are we now to expect, in the short term at least, to live with a little bit more inflation than we thought we were going to have to live with while they cut these rates to help that jobs market? Have they kind of turned their back on that mandate for the short term? What do you think?
It's a dual mandate, and it's an incredibly difficult balancing act. And I think everyone was living under this false premise, this false pretense, that you would need to get the inflation rate at 2% before you saw the rate cuts. No, everyone's going to have to live with a higher amount of embedded inflation in order to go ahead and protect this wonderful soft landing that has unfolded. So the inflation's going to remain entrenched. It's a year-over-year compound. At least it's trending the right way. But let's all get out of the Fed's way and let them do their job. And you know who needs to listen the most, Scott? Congress in DC needs to listen to the most, because any policies that are fiscally accretive, fiscal spending, will work in concert against everything the Federal Reserve is trying to do with their dual mandate. And that's who I hope is watching this television program right now.
Well, hopefully they are, because you're right. In the new Harris campaign, they've teed up about $3 trillion so far of spending that they would like to do if they get put in office in November. So that's something we're going to have to keep an eye on. So my ending note's going to be this. I don't know the answer, but I'm going to ask you. You know, to well and truly get inflation under control and have almost like an economic reset, you're going to have to put people out of work. That's just one of the things you got to do to really get to where you need to be. It's going to be hard to get inflation down to your goal with the 4.3% unemployment rate. What say you?
Yeah, it's going to be tough. We're going to need to continue to see the unemployment rate in this country at the headline level incrementally walk its way up. And that's just a natural reality, because the consumer is already getting more choosy. Dare some people say it's a little bit more frugal. And going back to that last point, it is both Republicans and Democrats who spend tremendous amounts of capital. So that was a message to everybody to get out of the way, let the Fed do their job. Let's all stay in our lane. And I just hope the magic can continue to happen, because I enjoy a porridge that's not too hot, not too cold. It still feels just about right.
Mr. Soft Landing. All right. I love having you on. Thank you very much. Craig Bolanos, he's the CEO and co-founder of the Wealth Manager Group up in Chicago. Thanks, Craig, for being on the show. By now,